I'm gonna do chapter 7, chapter 8, and then the exam 2 review. I'm gonna share my screen. Yep. Lost my screen. Do you see the whiteboard?
Yes.
It's got chapter 7 on it. You see that, my handwriting? Okay, I couldn't tell. I can't find my screen that shows me what's showing y'all, what's showing to y'all. All right. So chapter 7 is going over accounts receivable. And let me move this to the side. Okay. So accounts receivable is, it's an asset account. And we talked about last week, asset accounts have what normal balance, a debit or a credit? Do you remember?
The debit?
A debit. Yep. So when we are in business, we're going to either sell our services or we may have products that we sell. And we can use a process known as credit sale. So if you want to sell to people on credit, a lot of times you'll have a process in place that you will check their credit, make sure that their credit, you know, looks good. And if so, you'll move forward with a credit sale. And when you go to do the service or you sell the product, you won't get cash right away. You'll set up your sale, but you'll, instead of getting cash as your debit, your AR is going to be your debit. So your AR, your accounts receivable, represents money that you're going to collect in the future from them. And usually it's within 30 days, sometimes 40 days. Some people give 60 days. But a lot of times you'll have probably 30 days. Now, there are times that they can offer discounts. So if there's a company that says, if you pay me in 10 days, we'll give you the 2% discount. We talked a little bit about that with the payable side, but you can also do it on the receivable side. So that way, if you want cash to be coming in, you know, coming in on a regular basis, you can offer those discounts. You can also take credit card. So if you sell a credit, something on credit card, a lot of times the credit card companies want to charge a fee. They will say that it's 2% of the sales. So if your sales $1,000, they're going to want to charge 2% on that $1,000, and you have to pay a fee. So the way that we record those fees in the journal entry be a little different than if you just sold something on credit to a customer. A lot of software that you'll deal with will have an AR module, meaning that it will have a couple of different things. If you're familiar with QuickBooks, that's really good. When I'm explaining this, it's kind of following along with that, but a lot of the software is the same thing. You'll have a module called accounts receivable. In there, you'll have a spot to put all your customers in there with all of the information. You can have tax ID numbers, shipping addresses, mailing addresses, legal addresses, any information that you need as far as their addresses go, you can put in there. You also have their terms, if they get discount or if it's just net 30. You can have, sometimes software will have, you know, an account number that's used regularly or something that is like a memorized product they purchase. You can have defaults that's set to that, but you'll have information on all your customers in that database. You will also have different sections to go into to maybe do an estimate or prepare an order. Maybe you can have a pack and slip out of that AR module that goes over to, you know, from the inventory module. You can have invoicing in that system. So when you invoice, what's going to happen on the invoice is what we're going to learn how to do manually. So in the class, we'll go through entering everything as a journal entry. But keep in mind, the accounting software, when you're running accounts receivable, will do this automatically for you. It'll automatically know that you're selling Dawn $100 worth of products, and it'll go to her accounts receivable. And you'll have a debit in accounts receivable, and you're going to credit sales. The system will automatically do that for you. Once you have a bunch of sales, then you can run something called an accounts receivable aging, or the AR receivable report. Different systems call it different things, but you can get a report, and that report will show you each customer and how much they have that's open, how long has it been open. A lot of times they'll have columns. You can set it up to show months, like if it's, you know, this month is July, if you want to see the sales for July, June, May, and then it'll do everything before that in a far column. Or you can have 0 to 30, 31 to 60, 61 to 90, kind of like that. You'll have different columns on that report. A lot of times that can be customized. And so we're going to learn how to do the accounts receivable, but keep in mind the accounting software that you'll be using. If you go into an accounting department, a lot of what we learn with the journal entries are going to happen automatically. And the system is going to do a lot of that posting for you of those journal entries and getting the information into the accounting software. You will also have fees. You'll have general ledger accounts that will be able to capture the fees on credit card. And sometimes it automatically will do that as well. We'll learn how to do that on a journal entry. Then we also have installments. Sometimes you have a sale that you make and it's an installment. Maybe it's a bigger item and you want to set up payments with interest. You can do that as well. So that'll be a sale on sales on installment. Now, it'd be great if we collected everything that we sold, that we would collect all the cash on our accounts, but sometimes that doesn't happen. Periodically, people will get into trouble and they won't have the money to pay the rent, or maybe they won't have the money to pay that product that they purchased from you. Maybe they don't have the money to pay the service that you just provided. So they have methods to write off bad debts. If you can't collect, it's considered a bad debt. And so we'll go through the methods of that. A direct write-off method is very simple. The direct write-off means that I have a customer. So let me show you an example. Okay, so if I have a tenant, let's call him Don Joe. So he has a balance of $200 on the accounts receivable schedule. Right now, that's sitting as a debit on my books. It's an asset. I'm going to collect $200 from Don Joe. Let's say he can't pay, and I want to write that particular receivable off. The direct method just means I'm going to go ahead and write his off. So if I have a debit, I need to do the opposite to get rid of him. So I already know one side of my entry. One side of my entry is going to be to credit the AR for Don Joe $200. Now my other side, what do you think that's going to be? It's a debit. If sales go through as a credit, I need something that's going to offset that to reduce that amount that I'm going to be collecting. So and selling in my sales. What do you think is going to get debited? Any
The
guesses?
bad debit?
Huh?
Is it the bad debit or?
Yes.
Okay.
Yes. It's going to be the bad debt expense. So remember, your expenses are debits and they are reducing the revenue, and that difference is your net income or your net loss. So you want to make sure you debit bad debt expense for the $200. So that is the direct method. It's very simple. I have you know, a receivable that I'm not going to collect, and I'm going to write it off. I'm going to go back to the AR to that tenant, take it off, or to that customer and take it off, and then write off to bad debt expense. Or it could be, you know, a company name for a larger amount. You want to make sure that you write it off to that particular customer, tenant, client, whoever it is. Patient could be if you're medical billing. So that's the write-off method that's direct. If you want to do the allowance method, then it's a little bit different. The allowance just means that we're going to set up an allowance for the year. We're going to estimate how much we think we're going to have to write off, and that becomes my estimate. When I'm doing that, I have two ways that I can do that. We have the percent of sales method or the percent of receivables. So my allowance may be that it's going to be 1% of sales. Then I have to calculate how much was my, okay, look at my sales, how much was my sales, and then I calculate what I think, what, you know, 1% of that, whatever I think those sales are going to be. It's usually an estimate, and that's the number that I use, and I set up my allowance for the year. So I'm not writing anything off in particular. I'm not saying Don Joe is going to get written off right now. I'm not saying somebody else is going to get written off right now. All I want to do is set up the allowance. So let's take $1 million in sales, and it's going to be 1%. So you just do the calculation for that. So we're going to say 1 million times the 1%. It gives me the 10,000. Now I know what the amount's going to be that I'm going to set up for that year. I'm not specifically identifying anybody yet. I'm just saying this is what I think I need for an allowance. When I do my journal entry, my debit is going to be the bad debt expense. So I'm going to go ahead and write it off now. I'm hitting my expense account, and then I'm going to set up an allowance for doubtful accounts or allowance for bad debt. And it's going to be 10,000. That's my credit. Now my credit's going to sit there. And when it comes time to write off John Doe, I'm not going to set an expense up again like I did over here on the direct method. Instead of debiting bad debt when I'm writing John Joe on the allowance method, I'm not debiting bad debt expense because I already did that. I estimated 10,000. So now I'm going to debit the allowance for the $200, sorry. And then credit his account, the AR account, John Joe, for 200. So instead of hitting the expense, I'm hitting the allowance. And what happens is over the course of the year, let's say I had a T account for this allowance. It's starting with 10,000. As I go throughout the year, I just wrote the 200 off. So now I have 9,800 as my balance. So as you go, you would just continue to put the debits in that account, and that account gets reduced as you go through the year. So hopefully that makes sense. The percent of receivables, you're basically doing the same thing. The entry is going to be the same. You're going to be calculating an amount to set up in your allowance. The difference is we have to consider what's already in the allowance account, and we'll do a homework problem to show this. So what we'll do is look to see what are my receivables? How much do I have in receivables? What is the percentage that I think I'm not going to collect on that particular receivables? Maybe it's 2% of receivables. Then I would figure that out. So let's say my receivables was 10,000, and 1% of that is what I want to write off because I'm thinking I'm not going to collect 1% of my receivables. The expense for that year has to be $10,000 if it's on the sales method, because it's 1% of sales. On the AR side, when I'm using a percentage of receivables, I need to look to see what's in my allowance account already. Because if I have a balance in my allowance account, I'm going to take that into consideration. I'm not just going to say, oh, it's, 1 million in sales times 1%, or 1 million in receivables times 1%, and I get 10,000. If I have, a balance in this account, I'm going to reduce my $10,000. So in this case, my balance right now is 9,800. And if I'm going into a new year, because I didn't really have any write-offs this year, when I set up my new estimate, I'm only going to set up $200 to bring that account back to 10,000. So that's the difference between the percentage of sales and the percentage of receivables. And we're going to do an example to try to help understand that. And then we have notes receivable. Notes receivable just means that I have something that maybe I sold to somebody, or they've gotten behind on their account and they can't pay it within 30 days. And I make a arrangement that I'm going to set up a note, and I'm going to take that note, maybe it's $5,000 that's on their account that they can't pay, but they can pay it over time. So I'll set it up as a notes receivable with interest. And so basically you're just setting that up into a different accounts receivable account. You're not putting it into your control account, which is your accounts receivable for all your clients or patients or tenants. You're going to set that up differently into a different account. And then each month they'll pay the same amount. They'll have their monthly payment, and that will reduce their principal and their interest. So we have notes receivable that we'll set up sometimes. We've had this happen a couple of times. So at my work, we have tenants that pay rent. And when we went through COVID, a lot of the retail tenants were having difficulties paying their rent because they were closed. We closed our malls, for almost 2 months. So they didn't have any sales. And then when they came back, at the end of June, there wasn't a whole lot of people out shopping. So they weren't bringing in the revenue that they were used to. So we had a couple of local clients that were, having trouble. So we went ahead and set up notes receivable and pulled that money off of them and put it on the side and set up a note, and then they can pay it over time. So periodically you'll do that. All right, so let's look at Connect and go through some of the homework. Okay, so let's look at number 1. So we want to do a journal entry for the following credit card sales transactions. Okay, we're using the perpetual inventory system. So it tells us in number 1, we sold 22,000 of merchandise, which cost 16,600. On MasterCard sales, MasterCard charges 5% fee. So we already know that we're going to have to pay 5% of that sale. All right, so it wants us to record the cash when we receive it on 1A. So we're selling 22,000 of merchandise. The merchandise is 22,000, but what did we have to pay? We have to pay 5%. So you want to do the 22,000 times the 5% fee to come up with how much money are you going to have to pay the credit card company. So when you record a sale, normally if we were selling this for cash, or we were selling it on accounts receivable, when we sold it on credit sales, we would get the full $22,000. And we would record the full $22,000 as the sale. In this case, we're not, in this case, the cash that we receive is not going to be the full 22,000. We have to reduce the cash coming in or the accounts receivable coming in by the fee. So we have our sale of 22,000. We're going to record that as our credit. We know that already. We have 22,000 in sales, and we're going to record 22,000 in sales as a credit. The other side, because I'm not getting all of the cash, I have to reduce the 22,000 by the 5% fee. So when you take the 22,000 times 5%, that's your credit card expense. That's your fee, $1,100. Well, it's an expense. Expense will have a normal balance of a debit. And so when we do this entry to record the fee, we're going to put a debit for the credit card expense of $1,100. The difference is the cash that we receive, and that's what we'll put a debit into cash. That's money coming in. Okay, then we have the cost. It tells us the cost is $16,600, and we want to record that. So we have cost of goods sold as our debit, and our credit is merchandise inventory. So inventory is normally is a debit balance, a normal debit balance, because it's an asset. So we want to go ahead and credit that because we're taking that off the shelf and we're selling it. So we don't have it anymore in the shop, right? We're taking the merchandise, the inventory off the shelf, and we're selling it. That's why we're crediting, because normally that's sitting as a debit. And then the cost of goods sold, think about that similar to an expense. It's got to offset that sale. We're not making 22,000 on the sale because we're selling merchandise that we had to pay for. So we're not making 22,000, we're only making the difference, right? So the difference now, I have a sale of 22,000. So let's see what the net income was if that was just our sale. Let me bring my little calculator over. Okay, so can y'all see the calculator? Okay, so we had 22,000. That was our sale. So what do we have to find our gross profit margin? Remember when I was saying when you figure out your profit margin when you sell an inventory, you want to take sales minus cost of goods to get your gross profit, and then you take your operating expenses out and you come up with your net income. So in this example, we have 22,000 in sales, and we're reducing that by the cost of goods, which was 16,600, and we also have to reduce it by the 1,100. 4,300 would be our net income. So let me move that out of the way. So that was just a quick little recap of what we learned in the beginning. Okay, so number 2 says we sold 5,200 of merchandise, which cost 3,100 on an assortment of bank credit cards. These credit card charges a 4% fee. So again, we're going to do the same thing. We have a sale and we're taking credit card and they're charging us 4%. So are we getting all the cash? No, we're not getting the full 5,200. Our sales that we sold are 5,200. So we want to make sure we record it for the whole amount. So we have cash coming in, which is the 5,200 times the 4%. That's my credit card fee, $208. My cash is the difference, $49.92. My sales credit, 5,200. Don't forget, you got to record the cost, because you want to make sure that that cost that you paid for something, you want to reduce that inventory because the inventory goes out, and you also want to make sure you set up your costs to offset that sale to make sure you have the right net income. If you forget to do that part, what's going to happen? You would have your inventory overstated because you would say that you had 3,100 too much in inventory, so it's overstated. You would also have your net income overstated because you wouldn't be reducing it by the cost of that 3,100. So we debit cost of goods sold and we credit inventory. So that is a credit card sale and how to record the fees. Let's look at number 5. Warner Company's year-end unadjusted trial balance shows accounts receivable of 100,000. Allowance for doubtful accounts is 610. Credit balance. In sales of 290,000. Uncollectibles are estimated to be. Now this is where you have to pay attention. It says 0.5% of sales. Make sure you pick up if it's saying 0.5% of sales or is it saying 0.5% of accounts receivable, because it's giving you both it's giving you both. It's giving you the accounts receivable total, and it's also giving you your sales total. And on the exam, you want to make sure you pick up the right one. You don't pick the wrong one. So this is saying 0.5% of sales. So we just go to the calculator and we take our 100,000, that's our sales, times 0.5%. I don't know if I have a do I have a percent on here? Nope. So I'm gonna have to, did it do it right? Maybe not. I gotta do, okay, it's 0.5, so I gotta do 0.005, right? Okay, so it gives me 500. So my $500, and then it's saying that my, that can't be right. What's the 100,000 times, maybe it's got it on here.
I think it's 5,000.
Oh, it's got the 290. I picked up the wrong number. See, I just did it. Accounts receivable, what I'm telling you not to do, I just did. Accounts receivable is 100,000. Sales are 290,000. Sorry.
You put too many zeros, just 0.05. For like a basic calculator, just do 0.05.
I don't have the percent though. So I think it's supposed, because 0.05 would be 5%. 0.05 is 5%. So it's going to be 0.005, right? Let me see. Now I'm curious.
That's a 0.5%.
Yes. So since it's a 0.5%, I gotta do 0.005 because 5% would be 0.05, 2 decimal places.
Had 2 zeros.
Yeah.
I think you were putting 3 in.
Oh, okay. Yeah, so I have 0.005 now, and it came out. So I gotta do make sure you grab the right number. 290,000 is the number of my sales. So we do 290,000 times the 0.5%, and I get 1450. Now, the journal entry is using that number, 1450, because we're using percent of sales. If we were using percent of accounts receivable, that 610 credit balance and the allowance, we would have to take that into consideration. But because we're basing it on sales, we don't. So that's the entry. It's real easy. You just take the sales number, times it by the percent, and that's your number. So we debit bad debt expense and credit the allowance. Okay, let's look at number 7. So 7. All right, we have on August 2nd, June Company receives a $7,900 90-day 12% note from customer Ryan Albany as payment on his $7,900 account. So we're receiving it, and it says compute the maturity date for the above note. So we're saying it's 90 days. This happened on August 1st. Okay. So let's look at down here to do the calculation. So how many days do we have in August? We have 31 days, but this is dated August 2nd. So we have to take those 2 days out, and we have 29 days for August. And then in September, we have 30 days. October, we have 31 days, and that gives us our 90 days. Okay, so the maturity date is the October 31. The second says prepare the journal entry for August 2nd. Now, August 2nd is when I'm setting up the receivable. It tells me that I'm setting up a note for one of my customers, and it's to clear the payment that he has on account. So he already has an accounts receivable set up that he can't pay, and we're going to change it to a note, right? So if he has a note, I mean, if he has an accounts receivable already, that means it's already sitting on our books as a debit under his name. So we're going to credit that to wipe it out. So that's why we're crediting accounts receivable with his name, $7,900. Then we're going to debit the notes receivable because we want to make sure that we set that up now as a notes receivable. It's a different account, probably a different account number as well. A lot of softwares have numbers along with the descriptions. Okay. Let's look at number 10. Number 10 and then 13. Record the sale by Ballast Company of $143,000 in accounts receivable on May 1. Ballast is charged 4% factoring fee. Okay, so we're going to sell our accounts receivable. And so we're going to take those off of the books. Hi. But if somebody's buying my receivables, they're charging me a fee for that. So I don't get to have all of the cash. This is a accounts receivable that I've already maybe sold products or services I have on my books. And now I need to collect the cash. I can't wait for it to come in. Maybe the terms are net 60 and I don't have, I need the cash now. I can't wait 60 days to get the cash. So I'm going to sell my accounts receivable. There's a lot of times this happens in the medical industry. So if you have a bill that comes in from your doctor's office and you don't pay within a certain amount of time, a lot of times you'll get a notice from a collection company. That's what happens. Sometimes they sell it right over to a company and they don't deal with the collection part of it. They will, only use the ones that are current. They don't have maybe the staff on hand to make phone calls to collect on older accounts receivable. So they'll sell that off. Now, the company that purchases it doesn't want to purchase it for the full amount because they're taking a risk. Maybe they're not going to get the money. So a lot of times they'll charge fees and it can be way higher than 4%. But in this case, it's 4%. So all you do is take the 143,000, multiply it by the 40% to come up with the fee, which is 57.20. Now I need to remove my accounts receivable and I'm going to collect my cash less that fee. So how much cash am I getting? I'm taking the 143 less the fee. I'm getting 137,280. I'm debiting my factoring fee expense. That's an expense to me because I'm letting this go and I'm not taking, the full amount of cash. I'm gonna pay somebody a fee to take it for me and they can deal with the headache. So I'm gonna put it as an expense. That's a debit, 57.20. And then I'm removing the accounts receivable off the books. I can't leave them there. I don't want to show the accounts receivable any longer because I no longer have that money to collect from that patient, tenant, client, customer. So I want to take that off. So I credit accounts receivable for the full amount, 143,000. You want to take all of it off. Okay, and then let's look at number 13. So it's actually 13 and 14. This is the example of writing off by the percent of accounts receivable. We can say that we're going to take 2% of accounts receivable, or we can estimate a little bit, it's a little bit more complicated, but we can determine that if the older the receivable it is, the less likely it is that I'm going to collect on that money. So I may set it up this way. If you look at this table, it shows you your accounts receivable and how much money is in each one of those windows of time. So the 540,000 isn't due yet. I'm expecting that's a pretty good percentage that I'm going to collect that money. So I'm only estimating I'm not going to collect 0.9%. 1 to 30 days past due. So this is in my column that's 1 to 30 days is 216,000. I'm thinking that I'm not going to collect on that for 1.65%. And then it goes up as you go. So what this homework problem wants you to do is set the table up to find out what is the estimated that's not going to be collected. And then we're going to set up the journal entry, I think, on 14. Let's see. Yes. Okay. So this is just breaking your table out. You're just taking your numbers and plugging them in to the column that they belong in, the row that they belong in this case. And then you're saying what the percentage is right here. You're just getting that number from the top, putting it into its place. And then you have your estimated uncollectible. You're just taking the number that's in that category, which is not due yet, 540,000, multiply it by the 0.9% and get 4860. I do the same all the way down. 1 to 30, 216,000 times the 165. I come up with the number. So instead of saying my total receivable and I add all this up and I come up with a number and multiply it by maybe 20%, I'm not doing that. I'm breaking it out and saying, okay, this is how much percentage it's going to be for each category. So it's just a little bit more complicated. So this is what I'm expecting that I'm not going to collect, 20,542. That's my estimated balance that I want in my allowance for uncollectibles. Now, I have to look to see, do I have a balance in that account now? Because if I do, I need to take that into consideration. So we need to go back up here to the top, and it tells us the company has this much in sales in 18. And then it says the allowance for doubtful account has an unadjusted credit balance of 15,542. So that's the number we need. It's already got a credit balance of 15,542. Now, remember when we talked about it over here, when we set up our allowance, right here, our allowance is set up as a credit. So here it is right here. When this example we went through, the allowance is set up as a credit. So we already know that we have part of this 20,000 set up. So I need to look to see what the difference is. If I want 20,542, so 20,542 less the money that they're saying is already there, which is up here, this number here, 15,542. I need to deduct that from the 20,000 that I was coming up with. So my difference is 5,000. So for 14, I should be doing a journal entry for 5,000. And there it is. So on December 31, I need to expense an additional $5,000 in order to bring my allowance to this balance of 20,542. So I'm crediting the allowance for 5,000. I already had 15,542. So now when I have two credits, you add them together, it becomes 20,542. So hopefully that makes sense. Do y'all have any questions for chapter 7? Okay, let's do chapter 8. Chapter 8 is long-term assets. And this is where you learn about depreciation. So we have our long-term assets on the balance sheet. You'll have your most liquid assets first. So you'll list your cash and any other liquid assets that you may have. And then you'll list your long-term assets. So anything that's greater than a year. So in the section with my long-term assets, I'm going to have my plant assets. Well, what are plant assets? Plant assets are land, building, maybe land improvements. Maybe it's equipment or machinery that I purchased in order to produce a particular product. And I want to be able to capture that money that I've spent and expense it over a period of time. And there's different methods to do that. We call that depreciation. Also, when we have an asset, sometimes we purchase, it's not just land by itself or a building. A lot of times when you buy in the building, you also buy in the land. And so we want to value those separately. When we have land never depreciates. So we don't depreciate that on the books. It needs to be pulled out separately. So we'll go through that. And then when we purchase the equipment, a lot of times the equipment will have a salvage value. So maybe I can use it for a period of time. That period of time that you can use that product is called the useful life. And whatever it's worth in the end, that's my salvage value. So you'll see those words, useful life or salvage value. You'll have different costs that go into these things, and then you can set them up as a whole. Sometimes you have a sum purchase where you're buying multiple things at one time, and you need to figure out, okay, I'm paying X amount of dollars for these items. Now I need to figure out how much are those items going to be worth, and how much am I going to set those up for? So we'll go through that. The methods that we use for depreciation that we're going to talk about are straight line. I'm just going to divide it up over a period of time and expense it evenly. There's units of production. So this is a little bit different. It's we'll walk through this, or depletion. We'll walk through that because it's a little bit different than just having a product. It's going to be for bearing costs depending on a period of the useful life and depending on its usage. So you'll have to take that into consideration. There's also declining balance. This one is a little more aggressive. You're going to be writing more money off up front. So I'll walk you through the process of how to set the declining balance up and how to calculate that and how to get the number. And then we'll do journal entries. The journal entries sometimes are a partial year. You have to be real careful with that. When you're taking the test, you want to make sure if you buy something on January 1 and you're depreciating it for the whole year, it's real easy to say, okay, it's for 12 months. I'm just gonna, if it's straight line, I'm just dividing it, you know, by 5 years. That's how long it's good for. And then I'm multiplying it by 12, and that's my year expense. But if you buy it on July 1, then it's not for a full year. So you have to pay attention. Sometimes it's partial year. And the number you come up with, you wouldn't take, you know, the number when you divide it, let's say it's 5 years, you divide it by 5 years, you wouldn't take and expense that whole number in the first year because you didn't have it for the full year. So then you got to make sure you divide it by the 12 months to come up with a monthly number and divide it by, times it by 6 if it's for half the year. Sometimes we sell the asset, and that's the disposal. And we have to calculate, do we have a gain or do we have a loss on that disposal of the asset? We'll have to calculate what is the net value on the books? What's my net book value? And then what did I sell it for? And what's the difference? Did I sell it for more than what was on the books, or did I sell it for less? If I sold it for more than it's on the books, I obviously have a gain. But sell it for less, it's a loss. But I need to know how to record that on my books. How do I remove the asset? How do I remove the accumulated depreciation? And we're going to talk about that. I think I have one of the homework assignments. We're going to walk through that. Now, the other thing I want to mention is when we purchase the assets, a plant asset, if we have land or building, that's an asset. It sits on the books as a debit. When I depreciate it over time, I'm not going to adjust the value in the asset account. I'm going to leave that as is. I'm not going to put any kind of deduction in that account and offset it. We're going to use something called a contra account. A contra account is just going to be the opposite of what the asset is. So a contra account is going to be the accumulation of the depreciation over the period of time, and that will sit as a credit, and then we'll come up with a net book value. So when you're looking at a balance sheet, the balance sheet will list out your assets, and then you'll have a number that shows the depreciation or accumulated depreciation, and it'll deduct that from the asset to show the net book value. Okay, hopefully that makes sense. So 2 different accounts. One's going to be the asset account, one's the contra account. So the asset account could be building, and the contra account is going to be accumulated depreciation on building. A lot of companies use multiple depreciation accounts. You could use one if you wanted, but a lot of people will take and offset, like the land improvements is here, and then I'm offsetting that with my accumulated depreciation. My buildings here, and I'm offsetting that one with my accumulated building. My equipment's here, I'm offsetting with the accumulated equipment. Okay. And then we have intangibles. So things that you can't see, touch, like a patent or a copyright. These things are also an asset. And we want to amortize those over a period of time. So we were, record them if we buy a company and we feel that it's worth a certain dollar amount, we may call that goodwill. If it's a little bit more than what the value of their books has. So it might be that, I feel like, the books show that it's worth 100,000, but I'm willing to pay 150,000 for it. So you have 50,000 on this business that you're purchasing because you feel that it's valued at that, and that could be goodwill. The patent copyrights, I'm sure you're familiar with those. The patent is an exclusive right granted to the owner, and you can produce and sell that patented item. And I guess it's got a period of time on that patent too. It's limited. It's not forever, I don't think. I think most patents have a limit on the time frame. You also have copyrights, and so the copyright is an exclusive right to publish or sell music, literature, art, and that also has value, and you have to amortize that over a period of time as well. So we'll look at some of that. Okay, so let's go back to Connect. And we're going to go to chapter 8. Okay, let's look at number 3. So if a company acquires an ore mine at a cost of $3,360,000, it incurs additional costs of $940,800 to access the mine, which is estimated to hold 2,400,000 tons of ore. 250,000 tons of ore are mined it the first year, and the estimate value of the land after the ore is removed is $480,000. So it tells us what we're acquiring it for. It has an additional cost. It tells us how much we're planning on pulling out for the first year, and it has an estimated value in the end. So the estimated value in the end is our salvage value. All right, so our cost, the cost that we paid for it was $3,360,000, but we also had some additional costs, and we're going to add those in. So we just take the $3,360,000, the $940,800, and add them together to come up with the total cost of $4,300,800. Then we have our salvage value, which is given to us, $480,000. So there's our $480,000. So the amount subject to depletion. So we're going to deplete this over a period of time, very similar to depreciation. We just call it depletion because it's dealing with the minerals. So the amount to deplete, we're going to take what we paid for it less the salvage value, and that's what we're looking at, the $3,820,800. Now I need to figure out, I know that I'm taking about $250,000 out that first year, but I got to figure out how much is that per ton so I can calculate an amount that I can expense for the year. So I'm looking at $2,400,000 that I'm estimating I'm going to be able to pull out. And I need to figure out what that is per unit. Okay, so I got to divide it. So I'm taking the $4,300,800, which is my cost, less my salvage value. I'm coming up with the $3,820,000. And I take that and divide it by the $2,004,000. Does that make sense? I'm figuring out price per unit. So I'm taking my price over how much I'm estimating that I'm going to pull out. How much am I pulling out? It says I'm going to take 2,400,000 tons of ore. That's my estimate. So when I divide it out, I get 1.592 per ton. That's my estimate per ton. So if I'm planning on taking 250 out that first year, I just take the 250 and multiply it by my number. So 250 times the 1.592 gives me my depletion expense of 398,000. Okay, now prepare the journal entry to record the cost of the ore in the year-end adjusting entry. Now, I just calculated the amount right here, right? So we did that part. We just got to do the entry. My first entry is, what did I pay for it? Paid cash for this ore mine. So my asset is the ore mine. So I'm putting that on the books for what I paid for it. 4,300,800. Then I'm paying cash. So I would do a credit to cash. Now, maybe I didn't have the cash to purchase it. Maybe I did a loan. And so I would have a notes payable there. So I could have a liability instead of cash. That would be my credit. The second part is to record the first year. So I have depletion expense, or mine, 398,000. That's what we just calculated. And that's my expense. Now, notice I'm not reducing ore mine. Remember I said the asset has to stay by itself. Don't mess with that account. Once you buy it and you put the money in there that you paid for it, don't touch it. The credit's going to be the accumulated depletion on the ore mine, 398,000. So when you're looking at the asset on the balance sheet, you'll see the full amount of the ore mine, and then you'll see what was depleted over the period of time that you have. It's just going to be a dollar amount, and then you'll have the net. Okay, hopefully that makes sense. All right, so I had a request to do number 6. So we'll have to do 5 and 6 together. Okay, on April 1, now I haven't looked at this problem for tonight, so we're just gonna walk through it together. On April 1, 2017, Cyclones Backhoe Company purchases a trencher for $286,000. The machine is expected to last 5 years and have a salvage value of $43,000. Okay, so complete depreciation expense for both years ending 2017 and 2018, assuming the company uses straight line depreciation. Okay, so I need to calculate. This is telling me to choose my numerator. It's saying cost minus my salvage. So I paid $286,000 less the $43,000 that I'm expecting that it's going to be worth in the end. So the difference is what I want. That's my numerator, $243,000. Then I want to choose my denominator. So it's got a drop down menu. You want to use the estimated useful life. Well, how long does it tell me? It says it's going to expect to last 5 years. So that's my useful life, 5 years. So I'm taking the 243,000 divided by 5. That gives me the annual amount that I want to depreciate. So for 2017, the annual amount would be 48,600. Do I want to depreciate the whole year? I don't. I bought it on April 1. So there's 3 months that I didn't own it. So I don't want to depreciate those 3 months. That's why the fraction for the year is 9/12, because I'm only going to expense 9 months out of the 12. So my depreciation amount is going to be 36,450. I'm just taking that 48,600 and multiplying it by 9 divided by 12, and I get the annual amount, 36,450. For 2018, I have it the whole year. That's why it's 12 out of 12. It's 12 months out of the year. So I'm going to depreciate the whole amount, 48,600. Okay, so number 6 says compute the depreciation expense for both years, assuming that it's double declining balance. So now we have to know, how do we calculate double declining balance? Straight line is pretty simple. The straight line formula is just take the cost minus the salvage value and divide by the useful life. That's the amount that we're going to use per year. Real simple. Now, for the double declining balance, it's a little bit different. I have to look at how many years do I think this is going to last? So I have my beginning price, which was $286,000. Right here, it tells me that I purchased it for 286. So I put 286 as my beginning balance. My depreciation rate of 40%. We have to know how to calculate that. So I want to do 100% of 5 years. So I'm going to do the 1 divided by the 5 to get 0.2. So the example here for the rate is showing you 100% divided by 5. So the way I show it in class usually is 1 divided by 5. 1 divided by 5 is going to give me 0.2, 0.2, I think. Let's see, hang on. Okay, 0.2. Then I'm going to times it by 2 because it's double declining balance. So I'm going to times it by 2, and that gives me 40.4 or 40%. So I'm going to use 40% to depreciate. So I'm a little more aggressive. I'm not taking this and dividing it up evenly. I think that maybe this equipment's going to wear out in the beginning of the usage. So I want to depreciate more of it up front. So I take 286,000, which is what I paid for it. I don't consider my salvage value for double declining balance. Multiply it by 40%. And again, do the same thing. I'm not going to have the whole year because I only had it for 9 months. So I'm going to do multiply by 9 divided by 12 to come up with the expense. So it's 85,800. Okay, that's my accumulated depreciation for that year. 85,800. So what's my book value? I take the 286 less the 85,800. It's my 200,200. Now the next year, to figure it out, I use that number. So the balance is 200,200. Again, I multiply it by 40%, and that's the amount that I'm going to use for my depreciation. I depreciate the whole amount because I had it for 12 months. So the accumulated depreciation now is 165,880. So that comes from the first year, which was 85,800, and then the second year was 80,080. And I just add those together, and that's where the 165 comes from. It's just accumulating. First year, second year. Now my book value is 120,120. Okay. Now let's look at number 10 and 11. Milano Gallery purchases the copyright of an oil painting for $240,000 on January 1, 2018. The copyright legally protects its owner for 10 more years. The company plans to market and sell prints on the original for 19 years. Prepare journal entries to purchase the copyright on January 1 and the annual amortization. So I'm purchasing on January 1 copyright, and I paid cash. So I paid $240,000. Journal entry is very easy. We're going to do the copyright for $240, the cash credit for $240. December 31, I need to know what the amortization amount is for the whole year. So I need to calculate that out. Well, it's got $240,000 is what I paid for it, and the copyright protects me for 10 years. So I'm going to divide it by the 10 years, and that gives me my $24,000. So when I set it up, my amortization expense is a debit for $24,000 for the copyright. And then my offset, again, remember, it's not the asset, it's the contra account, which is the accumulated amortization for copyright. That's my credit for $24,000. And then the other one, I forgot which one it was. It's number 11. Okay. So this one is one that I wanted to walk through with you because it's when we were talking about buying assets, and sometimes we buy them as a bulk. So I wanted to walk through an example of that. So we're paying $820,000 for our purchase of these items. And we're getting a building, we're getting land, we're getting land improvements, and we're getting 4 vehicles for the $820,000. Now, they're going to tell me the estimated market value of each one of these assets. And I need that in order to be able to figure out the percentage that I'm going to set up for each one of these assets. So I'm going to go into my table. I have all my things that I purchased, the building, land improvements, vehicles. I'm going to set the market price in there, which is given in the example. So they tell you the values. The building's $492,500, you just plug it in. Land, $285,650, and you just keep going, plug everything in. So the total is $985,000. Well, I didn't pay $985,000. I only paid $820,000. And I need to figure out how am I going to divide up that $820,000 to each asset. So I'm going to figure out based on the market value. So I'm taking building. The building I say is worth $492,500. I'm going to divide it by the total of the market, which is $985,000. So I'm just taking $492,500 divided by the 985, and that gives me my 50%. I'm taking land, $285,650, and dividing by 985, I come up with 29%. Once I know the percentages for each asset, then I can multiply that by the price that I'm paying. So I'm paying $820,000. For building, I'm gonna allot $50,000 to building. So I take the 820 times 50%, which is 410. The 820 times the 29% for land, and that's 237,800. So that all you're doing is setting the table up. You're going to figure out your calculation based on the market value, and then you're going to use those percentages to break up what you're paying for it. So hopefully that makes sense. So when you set up your assets, this is the number you're going to use, the apportionate cost right here, this column. All right, prepare the journal entry to record the purchase. So what is the asset going to be? It's going to be a debit or a credit. Anybody want to answer?
It'll be a debit.
It's going to be a debit. Okay, so let's look at the journal entry. We're going to set up all of these separate for these amounts that are in the apportionate costs, and they're going to be debits. So here we go. Building 410, land 237, land improvements 32, vehicle 139.4, and then we're going to credit cash because we spent $820,000 on this on these assets. So that's our journal entry to record it. Then it says compute the depreciation for the year 2018 on the building using the straight line method, assuming 15-year life and a $31,000 salvage value. So remember what we said about land. We don't depreciate land. And it's telling me that the building is going to be a useful life of 15 years, and I have a salvage value of $31,000. So we have to keep that in mind. And I'm going to figure it out based on straight line depreciation. Okay, so let's look at number 2. So I'm going to calculate it out. I have $410,000 is what I paid, which is what we calculated out to be 50% of the 820. We determined $410,000. So the $410,000 minus the salvage value of 31 divided by the useful life. So cost minus salvage value divided by useful life is my formula for straight line. So I have 410 minus 31 divided by 15, 25,267. So that's the yearly amount. I purchased it on January 1. That's the beginning of the year, right? So I can depreciate the whole thing. So that's my amount, 25,267. Okay. Compute the depreciation expense on land improvements, assuming 5-year life and double declining balance. Well, we just figured out what it is, 40%, right? Because it's 1 divided by 5, which gives us the 0.2 times 2, and that's 0.4. So it's gonna be 40%. So I'm gonna take the amount that we determine is the amount for the land improvements, which is 32,800 right here. We calculated that out already. So we're gonna take the 32,800 and we're gonna multiply it by the 40% to come up with the amount. 13,120. Now, if you had to do the journal entry on this, you would go ahead and set up your expense as a debit for the depreciation on land improvements, 13,120, and your credit would be the accumulated land improvements, accumulated depreciation, land improvements, and that would be a credit for 13,120. Okay, so that was chapter 7 and 8. Do y'all have any questions?
Yes, number 12 at the end really messed me up.
Number 12.
That one.
Okay, let's see. Okay, so which part?
I think it was the last one. Let's see.
On December 31 of 2018?
Yes, number 6, like the 6th part.
Okay, so we have to figure out the depreciation for 2018. So let's see. Okay, so we purchased the loader and it was 250 plus 10,000 plus 1,800 for your life, 25,000. Okay, so we're adding it together to get the cost of the equipment, which was 261,800. We paid cash. And then we bought equipment. Let's see, paid 6,000 for the loader. Increase the estimated salvage value for the loader of 1,800. Okay, so I have an additional 6,000 for the equipment, spending cash. And now that changes my value. Okay, so that's going to change the value by another 1,800. Okay, so December 31. Okay, so December 31 of 2017, I'm recording the straight line depreciation on the loader. And we're taking the equipment, which was the 261,800. So we adding everything up. That was all my cost. The 250, the 10, and the 1,800 to come up with the 261,800. I need to subtract the salvage value. So let's see, the cost is 261 plus the 6,000 because I did a betterment on January 3rd. Now I have a revised cost, less the salvage value of not only the 25,000, which was given to me here, but it's saying that I have another 1,800 because of the 6,000 that was spent. So I got to add that together. So I have 26,800. Okay, and then it's 241, and I divide that by 4 years to come up with the annual amount. Okay, and that was purchased on January 1, so it should be the whole year, 60,000. Okay, paid 4,600 to overhaul the loader's engine, which increased the loader's estimate useful life by 2 years. So now I have to revalue it. I have equipment, 4,600, paying cash. February 17th, paid 1,150 to repair the loader. So notice on February 17th, I have a repair to the equipment. I'm not putting that to the asset account. Because it's a repair, I'm going to expense it. So it's not going to get part of the calculation. At least it shouldn't. Okay, cash as a credit. And then it wants me to record my depreciation. So I have to revalue it. So I have to look at where I was. So I had my total cost of the 26,800, plus I got to put the 4,600 now. According to January 1, 2018, I did an overhaul for 4,600. It's giving me 2 more years. So now I need to re-estimate. So I have my 267.8, which is just coming with my cost was from the previous year plus the new 4,600. I have to deduct what I accumulated the first year, which was the 60,000. So now I have a new book value of 212,000. Less my salvage value of 26.8. That didn't change, even though I have that transaction on the first to overhaul the engine. It's not telling me anything about increasing the salvage value. It's just giving me more life. So my salvage value stays the same. Once you figure out what you have left, then you need to calculate out how much time you have left. They're adding 2 years. So you had 4, it adds 2, which gives you 6, but you already depreciated 1 year. So I only have 5 years left. Does that make sense? So I have my original 4, and then I added 2, and then I took 1 more year away. So now I have 5. And the reason why I took the 1 away is because we already used it for the year. Now I have a revised amount. So I'm taking the 185,000 that was remaining, and I'm dividing that by the 5 years, and that's where the 37 comes from. So you're re-estimating. And when you re-estimate like that, you have to consider how long you have already depreciated on the books. Is that helpful?
Yeah, so I just wanted to ask again, you take the book value that you had at the end of the year or starting at the beginning of the year, and then you add your equipment, you don't do anything with the expense, and then you're dividing by 5 this time because you've already used 1, and before that you've increased it by 2. Is that correct?
Yeah, because originally you started with 4, and it's telling you getting 2 more years. So instead of having, you already used it for 1, so you had 3 remaining years, but now that you spent the additional money, you have it for 2 more years. So you had 3 plus the 2, that gives you your 5. And then you do have to consider the new cost that you spent, which was 4,600. So you're just going to add that, and it's okay either way you want to do it. So at the end of the first year, you can take, you know, what that cost was, the 261.8 plus the 6,000 less your depreciation, and whatever that number is, then add the 4,600 to it. You could do it that way, or you could do like they did. You just take the total cost, which was the 267 from the first year, plus the 4,600, and then deduct. So you can do it either way. Just come up with that book value. So the book value, if you do your entries and you're following the asset on a T account, let's just say you had a T account. Let me see if I can split the screen. So if you do a T account for this, oh, it's going to go away because I got to split this up. Okay. So maybe I can do it like this. Okay. Nope, it's not going to do it. I have to make it tiny. Okay. There we go. All right, so here's my equipment. So when I purchased my equipment, it's 261.8. And then I spend on January 3rd, 6,000. And then on January 1 of 2018, I spent another 4,600. So that's my equipment. And it gives me a total of, let's see, so this is well, it's 261, so that's 2. How much was it? I can't even add it up. My numbers aren't in the right spots. Let me just get to it. So I have 267.8 plus the 46, so I get the 272.4. So there's my balance on my equipment, and that's never going to change because it's an asset. It's just going to stay on the books for that price. Always. That's going to be my cost. And so when I look at the equipment, it's always going to have that cost. So that's everything. That's what I paid for it initially, the 6,000 I invested, and then an additional 4,600. This doesn't look like a zero. Okay. Then I have my accumulated over here. So I had that 1 year that we depreciated, and it was the 60,250. And so it sits on the books this way as my equipment, and then my accumulated for the equipment. So the difference is the net book value. So I take the 272.4 less the 60,250, and that's my 212,150. So that's how much it is on my books. So if you were looking at your accounts from your journal entries, it kind of makes it a little bit easier if you know how to do the T account, or you know how to look at the journal entry and see what's happening, what's in the account. That can help try to figure out where you are with the equipment. What's the net book value? And that's what you're looking for before you do the depreciation. So you want to make sure you have the right net book value in order to divide it up, or take your salvage value into consideration. The salvage value isn't on the books. You're just using that to help with the calculations of your depreciation. Okay. Let's look at the review sheet that I put up. So these are types of things that you need to know for the exam. How to calculate the cost of goods sold and gross profit. So we talked about that. Sales minus cost of goods sold is the gross profit. Know how to understand if it's overstated or understated. So if there was an error and you know your inventory, you brought in at a certain price and you realize, okay, so that cost that I have as my inventory maybe was 50,000, but I put it in there, 10,000 too much or 2,000 too little. You have to know how to understand if it's overstated or understated. And I put an example in there for that. Know how to calculate the cost of goods sold. So you need your beginning inventory plus your purchases to get your cost of goods that's available. And then once you know what's available, you can subtract out the ending inventory, and that gives you the cost of goods sold. Or if you needed to calculate the ending inventory, you can rearrange the formula. So it'll be the cost of goods available minus the cost of goods sold gives me my ending inventory. All right, so here's a little example. So we have sales of 430, and then we want to calculate the cost of goods and what's available and what's sold. So we have beginning inventory of 162. We're going to add our purchases, 293. So once I know everything that I have, that's what's available, 455. My ending inventory is 164,000. Well, the difference between what I had available and what I have in ending inventory is what I sold. So I take the difference, cost of goods sold is 291,000. And then my gross profit, how do I calculate the gross profit? It's right here up here on this little bubble, sales minus cost of goods sold. So I take sales, 430, minus my cost of goods sold, which is 291, and that's how I come up with 139. Okay, so if ending inventory is overstated by 20,000, so using the same example, ending inventory is 164. If I overstated that by 20,000, then what would the gross profit be if we needed to fix it? So in order to do that, I have to remove 20,000 from the ending inventory because I said I overstated it. Overstated it means I put too much. I showed that I had too much. I actually had 20,000 less. So I need to remove it out of my inventory. Well, where does it go? When I remove it out of my inventory, it's a cost of goods sold. So that means it's going to reduce my profit. So I'll take the 455 minus 144,000 because I'm deducting 20 out of the end of inventory. And now I have 311,000 as my corrected cost of goods sold. Now to figure out gross profit, I have to take sales minus cost of goods sold, which is the 430 minus the 311, and I have 111 as my corrected gross profit. Now let's flip it. Ending inventory is understated by 20, which means I don't have enough ending inventory showing. So I have to add that back in. Now my ending inventory is 184,000. So let's do the calculations now. So I have available 455 minus the 184. That gives me my new cost of goods sold of 271,000. So the profit would be the sales 430 minus the cost of goods sold 271. So now my gross profit is 159. So I just kind of understand how to process that because you'll have a question similar to that. Calculate cash and cash equivalents. So they're in the chapter. If you read through, they'll tell you what kind of accounts are cash equivalents. So you'll need to be able to pick those out. Know how to do a journal entry to record the cash sale, including cash over short. So I don't know that we did an example like that, but I think you had a homework problem with that on it. If you have the petty cash box, a lot of times the cash over shortage happens, and it's similar to the cash sale. So let me know if you have any questions about that one. We can try to do an example. Calculate gross margin ratio. That's just formula. And be able to use that percentage to find the gross profit. So once you find the ratio, you should be able to find the gross profit from that. All right, calculate days sales and inventory. You had some homework with that. Calculate inventory turnover. Again, it's just a formula. They'll give you the numbers. Calculate asset turnover ratio and understand what that means. Know how to calculate the cost of goods sold and inventory using the perpetual inventory system. This was chapter 4, I believe, with weighted average, specific identification, LIFO, and FIFO. So we did some examples on the last Zoom call that's recorded. If you need to go to that link, I sent an email out to the YouTube channel that has the link. I couldn't post it on Moodle. The file was too big. So I'll probably do the same thing with this video, is just send the link out. But know how to calculate using all of those methods. So I'm not sure if you're going to see every one of them on the exam, because I do have a pool of questions, and I'm not sure what you're going to get. You may get 2 specific, or you may get 2 weighted average, or you may get 1 LIFO, 1 FIFO. So you need to know how to do them in case, one of them pops up. Don't expect that you are going to get the specific identification, because you may not. You may get the LIFO instead.
But it won't be like a whole version of like number 13 on the test though.
I'm not 100%. I'd have to look at 13.
It was one where it was like LIFO, FIFO, the weighted average. I think it was chapter 5.
Yes, chapter 5 is inventory, I think. Let's see. So you said number 13, you think?
I think it's 13.
Let me look at it. I don't know that it's going to be as complicated as the homework. Usually the homeworks can be a little harder.
13. Chapter 5.
Yeah, I see it. So you had to figure out all 4 methods for the homework, and I don't think it's like that on the test. You're going to have to do 1 for the question.
Just the weighted average part took me forever.
Right. No, it's not going to have that many transactions. And Let me see if I can look at the test and I can find it just to make sure, but I don't think I would have put anything that complicated on the exam. One, it's just time consuming and we're limited on time. You're getting exposed to it through homework. And so I want to make sure that you have, enough time to go through it, but I want you to understand it too. And that's why I put it on the homeworks to make sure you understand and you're exposed to it. Because if you're an accounting degree and you go to intermediate, you're gonna need to know how to do that. Let me go through it real quick and just see. Okay, so I'm looking at one right now. And you have the beginning, you have a purchase, you have a sale, you have a purchase, and you have a sale. So it's not as complicated as that one. There's only 4 transactions.
Okay, thank you.
And it's only asking for using one method. So you won't have to do all 4 methods like that. Look at this one. No, okay. There's a lot, there's a lot of questions you can pull from, and there's only so much you can ask, on the test. It's 32 questions. And so I have to make sure you have enough time to get through all of it. Yeah, so I saw the questions that I have for that are the same. They're the 4 transactions. And it's just going to ask you to one method. So it won't be that complicated. Know how to do your petty cash journal entries. Bank reconciliation. So on the bank reconciliation, we talked about transactions that had journal entries and ones that didn't have journal entries. So I want to make sure you're familiar with that, because you'll have to determine if you have to do an entry or not. All right. Customer write-offs, we went over that tonight with the direct method or the allowance method. And the main thing to remember is make sure you pick up the right number if it's the allowance method. Make sure that you pick up the % of sales. Make sure you pick up sales, not the accounts receivable number like I did earlier. And the other thing to keep in mind is with the receivables, you have to make sure that the balance in the allowance is taken into consideration. So you don't want to get confused on that. That's the most important thing with that. The pledge receivables journal entry, we went over one of those. Notes receivable, how to calculate the interest and do the journal entry. You have, I think you have a homework problem like that one. Journal entry to record the credit card sale that charges fees and record the cost, just like we did today for the homework. Depreciation, calculate the amount, know how to do the journal entry. Straight line method and double declining. Those are the 2 that are going to be on the test. So we talked about how to do both of them tonight. And the main key is for the straight line, make sure that you know that that is cost less the salvage value divided by the useful life. For double declining, we don't look at the salvage value. You look to see how many years is the useful life. We had 5 on both examples that we did today. It was 1 divided by 5 to get the 0.2. But let's just say it was 4 years. It would be 1 divided by 4. So it'd be 0.25 times 2, which would be 0.5. So 50%. We would depreciate 50% the first year, and then we take the balance and depreciate 50% of Okay, then disposal of assets, how to calculate the gain or loss. So we talked about how to come up with the net book value of your asset. And let's see, let me get back to my whiteboard. So let's just do a quick example on that because we didn't do that earlier. Okay, so we have an asset on the books that we paid, let's do easy numbers, 100,000. And we have accumulated depreciation, 50,000. So my net book value, I have to know how to calculate that. It's going to be 50,000. So I have asset on the books. I have an accumulated depreciation of 50,000. My net book value is 50,000. If I sell it for 60,000, am I going to have a loss or a gain? Well, my net on the books is 50,000. Sold it for 60. So I have a $10,000 gain. If I sold it for 40,000, well, then I have a net of 50. I sold it for 40. Well, I'm gonna have a loss of 10. So that's my loss. So you have to know how to calculate that out. If I need to remove it off my books, my asset is a debit, right? It's an asset account. It carries a normal debit balance. The accumulated depreciation is a contra account. So it's going to be the opposite, which is a credit. If I want to wipe them off the books, what do I need to do? I need to debit this one, and I need to credit this one. Okay, so I'm going to do the accumulated depreciation, and I don't know if you have to do the journal entry. Let me, guess I need to look and see if you need to know how to do that. So my accumulated is 50,000. It's going to be a debit. I know that I'm going to have a credit for the asset, which is 100,000. I'm selling it, so I'm getting cash. Cash is coming in. Let's do the one with the gain. So I'm taking in cash of 60,000. So notice I have 60 plus 50. I have 111 on this side. I mean 110 on this side, and I have 100 on this side. So if I have a difference of 10,000, I have to put it as a credit. And that makes sense because it's a gain, right? So it's going to be a credit gain on the sale of an asset of 10,000. So now I have 110,000 on my debit side and on my credit side. Let me see if I can find that question. It's just how to calculate it. It's not the journal entry. But it's good to know how to do the journal entry, because if you want to remove it, you just do the opposite of what the balance is to remove it off the books. And then you have to deal with your gain or your loss. So if this was the loss, then I wouldn't be getting cash of 60. I would only be getting 40. So now I have 90 on this side and 100 on this side. Well, now I have to have another debit, and that would be loss on the sale of an asset for 10,000. All right, do you have any other questions? This sheet is on Moodle. To go through, you can do the practice homeworks, and through the chapter, there's some, the quick study. A lot of times I use the quick study questions for the homework questions because I like them. And some of the exercise problems are also part of the homework. Sometimes I even use those on the test because I do like how they ask those questions. So y'all feel good?